Welcome to Daily U.S. stock. We watch markets with calm focus and sharp instincts. Friday, February 6, 2026, a day that goes straight into the Dow's history books. The Dow Jones ripped more than 2% and closed above 50,000 for the first time ever, a milestone that screams confidence in blue-chip, economically sensitive names at the index level. It looked like a classic risk-on snapback. The S&P 500 and the Nasdaq both vaulted higher, breaking a multi-day slide as semiconductors and tech hardware roared back. But this wasn't some simple everything-up kind of day. Amazon sank more than 5% on a shockingly large AI Capex plan. Other hyperscalers struggled too, even as Nvidia, AMD, and Broadcom led the charge higher. So the headline story is historic highs and AI enthusiasm. The subplot's more complicated, a market leaning hard into AI infrastructure winners, while quietly punishing the big spenders and flashing subtle stress just under the surface. Pull up today's S&P 500 heatmap and the first impression's simple, a sea of green. Semiconductors jump off the screen. Nvidia, Broadcom, AMD, Micron, all glowing bright, saturated green. Around them Oracle, IBM, Cisco, and the chip equipment makers paint a clear AI hardware cluster, and the strength doesn't stop at tech. Industrials, especially aerospace and machinery, GE, Boeing, RTX, Caterpillar, are solidly green. Big banks and asset managers like JP Morgan, Bank of America, Goldman Sachs, Morgan Stanley, BlackRock all join the move. Even consumer staples, Walmart, Costco, Coke, Pepsi are shaded green, giving the board a broad, confident feel. But you can't miss the Scarlet tiles. Amazon is bright crimson after its more than 5% drop. Alphabet and Meta are in the red too. Pockets of healthcare, some REITs, and a few utilities show darker, more muted colors. Visually, it's a classic relief rally with a twist. AI infrastructure and cyclicals are carrying the board, while a handful of mega-cap spenders and defensives quietly bleed. That heat map tells you what moved. Now let's talk about where the money actually went. Under the surface, this was a textbook rotation back into cyclical growth and AI infrastructure. Capital poured into semiconductors and hardware, Nvidia, Broadcom, AMD, Micron, as traders reframed those huge 2026 AI Capex plans as revenue visibility for the chip complex, not just a profit drag for big tech. Industrials caught a bid on the same story. Aerospace, defense, heavy machinery names like GE, Boeing, RTX, Caterpillar, Lockheed rallied on the idea that the AI build-out also needs real-world infrastructure: power, cooling, logistics, physical capacity. Financials joined in as higher equity prices contained credit risk and a soft landing backdrop supported large banks and asset managers. Even consumer staples and energy, including Exxon, participated, giving the move a late-cycle, risk-friendly flavor. On the flip side, communication services and parts of consumer discretionary, Amazon, Alphabet, Meta took hits for their own massive AI spending ambitions and softer near-term margin outlooks. Scattered weakness in healthcare, REITs, and utilities suggests those defensive, yield-oriented pockets were a source of funds. So the rotation message is clear: embrace the capital equipment winners of the AI arms race, and demand proof from the hyperscalers that gigantic Capex plans won't crush cash flow. Put it all together, and today's tape looks both powerful and uneasy. The Dow's move through 50,000 plus big gains in the S&P and the Nasdaq screams risk is back. Breadth was solid with many cyclical groups and even staples tagging along. But leadership was concentrated. AI chips, select industrials, and financials did the heavy lifting, while Amazon, Alphabet, Meta, and certain rate-sensitive and defensive pockets quietly lagged. Options desks reported active hedging around upcoming jobs and inflation prints, and the broader commentary said today's melt-up felt more like a release valve after a bruising tech sell-off, not some carefree blow-off. In other words, the bull trend's still intact, but it's evolving. Investors are willing to chase winners, yet they're starting to draw hard lines between AI stories backed by cash flows, and those backed mainly by spending promises. Behind the screens, the conversation today was loud and divided. First theme: is this an AI Capex bubble or the start of a multi-year picks and shovels supercycle? Desks were openly debating whether the hundreds of billions in 2026 AI spending guides from Amazon, Alphabet, and others mark a blow-off top, or just the early innings of a hardware boom. That framing clearly powered the aggressive buying in Nvidia, Broadcom, AMD, and Micron. Second, chatter swirled around Nvidia's relationship with OpenAI. Reports of a large investment and efforts to quash rumors of strain in that partnership fed a narrative, still partly speculative, that Nvidia is embedding itself deeper into the AI software stack, not just selling chips. Finally, macro positioning with jobs and inflation data delayed and looming. Some traders framed today's ramp as systematic and discretionary re-risking after a volatility spike, rather than a clean macro re-rating. That view kept hedging activity alive even as the major indices shot higher. None of this is settled fact, But this is the rumor mill that shaped how aggressively investors leaned into AI hardware and how cautiously they treated the big AI spenders. Today we're diving into a foreboding technical signal flashing across Wall Street, the Hindenburg omen. Even with the Dow hitting a historic 50,000, this rare signal points to a major split in market health. It's not a guaranteed crash, but it is a warning that the foundation of this rally is thinning. The omen triggers when four conditions line up. First, you get a high number of stocks hitting new 52-week highs, while a similarly large group hits new 52-week lows. That fragmentation is the perfect storm. Second, the S&P 500 stays in an uptrend, but the McClellan oscillator turns negative, showing the average stock is losing steam even as the big names soar. We've seen 8 of these signals in the last 6 months, with 3 just this week. History says that while any single signal can be a false alarm, clusters like this showed up before the crashes of 1987, 2008, and 2022. So while AI giants like Nvidia push the indices to record highs, the Hindenburg omen is hinting that the tide's going out for everyone else. Watch the breadth, not just the headlines. Let's kick off the single stock deep dive with Nvidia. Nvidia ripped about 7 to 8% today, a powerful rebound after this week's AI spending scare. Flows rushed back into AI hardware, and Nvidia was right back at the center of that trade. Traders pointed to reports that Nvidia's deepening its role in AI infrastructure, including a large investment commitment to OpenAI, as fuel for the move. That narrative, even with some elements still in the chatter bucket, reinforced the idea that Nvidia is more than just a chip vendor. The surge made it one of the primary drivers of both the Nasdaq and the Dow, which now includes Nvidia in its membership. And the signal was clear. Investors are still willing to pay up for what they see as the leading winner of the AI build-out, even after a bruising tech sell-off. In this market, Nvidia still sets the tone for the entire AI complex. When it squeezes higher like it did today, broader risk appetite for AI doesn't just survive, it expands. Next up, Broadcom, one of the clearest winners in today's AI rotation. Broadcom jumped more than 7% after disclosures that Google plans roughly $175 to $185 billion in 2026 AI Capex and has already placed sizable TPU orders with Broadcom. That news cemented Broadcom's role as a crucial supplier in AI networking and accelerators. Instead of punishing the spending, the market capitalized it into the supply chain. This is the pure sell the AI spenders, buy the chip suppliers playbook in action. Amazon and Alphabet take the valuation hit for massive Capex, while Broadcom gets rewarded as the picks and shovels provider. For investors, Broadcom's spike drove home a key message. If the hyperscalers keep spending at this scale, someone downstream is going to see that cash, and today Broadcom was one of the biggest winners. AMD was another star in today's chip resurgence. After a guidance-driven sell-off earlier in the week, AMD ripped about 7 to 8% in a sharp reversal. Reports of extended lead times for server CPUs in China reminded investors that the long-term AI and data center thesis is still very much alive. As a high-beta AI hardware name, AMD is often where short covering and re-risking show up most violently. Today's move said positioning was offsides, and traders are quick to buy dips in what they see as a second-tier, but still powerful, AI winner. AMD's snapback didn't just add points to the Nasdaq. It confirmed that the broader AI chip complex still has plenty of speculative energy behind it, especially when fears around hyperscaler spending start to ease. On the downside, Amazon was the day's glaring outlier. While the indices surged, Amazon fell more than 5% after earnings. Management rolled out plans to spend about $200 billion on 2026 Capex, way above what many expected, and guided first-quarter operating income below consensus. That mix stoked fears that AI and cloud investments could crush near-term free cash flow, even with solid up GBTC U.S. and revenue performance. In a tape dominated by green, Amazon was a bright red drag on both the Dow and the Nasdaq. The market basically used Amazon as the poster child for a new kind of AI skepticism. Enthusiasm for the tech, but resistance to open-ended spending without a clear payoff path. Today's message was blunt: investors are no longer automatically funding limitless AI infrastructure. Even at a mega cap like Amazon, the bill now matters. Alphabet tells a similar, but slightly different story. The stock stayed under pressure as investors kept digesting a 2026 Capex forecast in the roughly $175 to $185 billion range versus expectations closer to $120 billion. Even with strong fourth-quarter results and robust Google Cloud growth, that spending path spooked parts of the market. Alphabet, like Amazon, landed on the wrong side of the new AI trade, punished for massive Capex, even while its suppliers surged. The reaction drove home that great AI narratives and solid earnings aren't enough anymore if the investment bill looks open-ended. Alphabet's in the penalty box until investors believe those dollars will turn into durable, high-margin returns. In this phase of the AI cycle, GOOGL is a case study in how fast sentiment can flip when Capex races ahead of comfort. Let's wrap the cross-asset picture with crypto through the lens of GBTC. Bitcoin stabilized near $70,000 after earlier sharp losses, and that rebound helped lift Bitcoin-exposed vehicles like GBTC. The move linked today's equity strength to a broader cross-asset risk revival. As crypto sentiment improved, GBTC's gains added a speculative edge to the session, right alongside the rebound in high beta tech and AI hardware. For traders, that combo, AI chips ripping, Amazon under pressure, Bitcoin bouncing, painted a market that's willing to embrace volatility again. But in a very selective way. GBTC's action doesn't drive the S&P 500, but it does confirm that risk appetite stretched well beyond just the big index names. So where does all of this leave us heading into next week? On the calendar, traders are eyeing a run of U.S. labor and inflation data, plus consumer and wage numbers that could quickly reset expectations for the Fed. With the market already snapping back hard, those prints could easily stress test this new risk-on stance. Right now, positioning looks like selective risk-on. Investors are leaning into growth, cyclicals, and AI infrastructure, but with much tighter scrutiny on valuation, Capex, and execution at the hyperscalers. At the same time, that Hindenburg-Omen cluster and other breadth warnings say you shouldn't take the surface strength at face value. Record highs can absolutely coexist with rising internal fragility. The big theme to watch: does the AI divide winners in chips and equipment, laggards among the biggest spenders, widen from here, or start to heal as guidance and macro data roll in? To wrap up, today's session was a study in contrasts. The Dow cleared 50,000 for the first time. Semiconductors, industrials, financials, and even crypto-linked names all pointed to a strong revival in risk appetite. Yet Amazon, Alphabet, Meta, and selective defensives reminded everyone this isn't a carefree melt-up. It's a market rewarding AI infrastructure winners and disciplining the biggest spenders, even as technical signals flag a thinner foundation underneath. As we head into a packed macro week, keep your eyes on two things: the data and the breadth. The next phase of this bull market or the next correction will probably be defined by how those two stories intersect. We'll be watching it all from Dow 50,000 down to the individual names that are quietly telling the real story. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.